This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
If the incoming data support the view that the economy is able to sustain a reasonable cruising speed, we will ease the pressure on the accelerator by gradually reducing the pace of purchases. However, any need to consider applying the brakes by raising short-term rates is still far in the future.
The tale of the taper. The Federal Reserve Chairman lays out a possible roadmap for scaling back on stimulus. Stocks sink, bond yields jump, and now we'll see what it all means for your investments.
Treating obesity. 1/3 of American adults and 17% of children are now considered to have a disease. And it could have implications for doctors, patients, insurers, and the cost of care.
Safety on the rails. Congress questions the effectiveness of a new safety mandate and scrutinizes the price tag. All that and more tonight on Nightly Business Report for Wednesday, June 19th.
Ben Bernanke has spoken, and now investors all around the world have a much better idea of when the Federal Reserve will start cutting back on its massive stimulus program. The Fed chairman said that process could begin later this year, and the bond purchases could end completely by the middle of 2014. But only if unemployment and housing continue to improve. Wrapping up a two-day policy meeting, Ben Bernanke noted that the economy is doing better. Still, policymakers left the Fed's key interest rate unchanged at 0%. Investors didn't like what they heard, and stocks and bonds sold off on the news. The Dow tumbled 206 points, the Nasdaq lost almost 40, and the S&P was down about 23 points. In the bond market, yields on the 10-year Treasury note shot up to 2.35%. That's a level we haven't seen since March of last year. Our Steve Leisman has more on Bernanke and today's Fed News.
Federal Reserve Chairman Ben Bernanke dropping something of a bombshell on markets today, saying that if the economy follows the path that the forecast says it will, then the Fed could begin tapering its asset purchases by the end of this year and ultimately end them in the middle of next year when the unemployment rate is around 7%. Here's what he said in his opening remarks.
If the incoming data are broadly consistent with this forecast, the committee currently anticipates that it would be appropriate to moderate the monthly pace of purchases later this year. And if the subsequent data remain broadly aligned with our current expectations for the economy, we would continue to reduce the pace of purchases in measured steps through the first half of next year, ending purchases around mid-year.
In the Fed's Open Market Committee statement today, there were also some surprises. The Fed said that the risks to the labor market and the economy had diminished, so a little bit more upbeat. And the Fed also reduced its forecast for inflation by a very strong 0.5 point this year, all the way down to 1%. The Fed says it's looking for 2% inflation. But of course, the Fed continued the current purchases. So one of the big headlines is there was no tapering. And there were actually not one, but two dissents in the statement today. Federal Reserve President of St. Louis, Jim Bullard, dissented for dovish reasons. He thought the Fed is not aware enough of inflation, while Esther George from Kansas City says she did not support the idea of the additional asset purchases by the Fed. For Nightly Business Report, Steve Leisman.
And joining us now to talk more about the Fed and the economy, Mark Zandi, Chief Economist for Moody's Analytics. Mark, good evening. What did we learn today?
Well, we learned that the Fed is going to start tapering QE at the end of the year, end QE by this time next year, and start raising interest rates by the early part of 2015. Of course, that all depends on the economy and that the economy sticks to the script that the Fed believes that it will. And that's the most likely economic scenario and the most likely interest rate path.
So, Mark, what do you think of this timetable? Do you think that the economy is ready to have the training wheels come off?
Yeah, I do. I think that by late this year, the fiscal headwinds, the tax increases and spending cuts will begin to fade. That'll let the better private economy start to shine through. That'll be more job growth and lower unemployment. You know, that is a long, arduous narrative and story, but I think it is the best and most likely story. And yes, at that point, I think it makes sense to start tapering QE, ending it, and starting to raise interest rates.
If the economy is getting better, which allows the tapering of the QE, why did the markets react so negatively?
Yeah, good question. If you read sort of the fine print in the FOMC statement, it was pretty hawkish. They dialed back their worries about the risks to the economy. They lowered their forecast for the unemployment rate. They even dismissed the lower inflation as just being temporary. So I think the markets took a look at that and said, maybe the risks are higher that they're going to end QE faster than we had anticipated just yesterday or the day before. The other thing I would point out is, these markets, the bond market, the stock market, all the markets have come a long way over a very short period of time. So they're very vulnerable to any little thing that goes off script. And so that may be also contributing to the ups and downs in the market that we're seeing in the last few weeks.
So investors also want to get a handle on where interest rates are going, both for the 30-year mortgage in the housing market and also on the 10-year. How much higher is it going to go? What are your forecasts for the rest of this year, and what impact is that going to have on the still fragile housing market?
Well, the interest rates are going higher. They're going to go up and down and all around. That's what interest rates do. But my sense is that by the end of the year, certainly by this time next year, interest rates will be higher, and they're going to move steadily higher over the course of the next several of years. That will be hard for the economy to digest. But if they're rising because the economy is improving, because we're creating more jobs and unemployment's moving lower, then I think the recovery will remain intact and be okay, and housing will be okay because the better job market will trump the higher interest rates, and we'll be just fine.
Very interesting. Mark Zandi, always great to see you. Thank you for coming by tonight. Mark is chief economist with Moody's Analytics. Susie?
All right, Tyler, so how should you be investing based on what Ben Bernanke said today? For some answers on that, we turn now to Jim Paulsen. He's chief investment strategist at Wells Capital Management. Okay, so we saw, Jim, how the market responded to all of this news. What should individual investors be doing? Should they be making changes in their portfolios, whether they own stocks or bonds?
Well, I've been on the view that we'd reach, the S&P would reach 1,700 this year, and about a month ago we did that, Susie, and I'm not inclined really to raise that target for this year. I think the stock market has entered a broad trading range, let's say somewhere between 1,600 and 1,700 for the rest of this year, perhaps. It's going to have to digest rising bond yields, as Mark just said. I think they're going to continue to rise through the balance of this year, or the 10-year yield might end the year closer to 3%. And it's going to have to digest the end of quantitative easing by the Fed. But I think the economy is going to continue to prove better than expected, keeping stocks from falling very much. So I would take advantage of this trade range, if you will. Number one, make sure that you're down, not as exposed to bond prices as you've been perhaps, because yields are going to go higher and bond prices are likely to fall. And within the stock market, take advantage like days like today when it really comes down to maybe add a little bit to stocks that you'll want to hold into 2014. And that would be, to me, some more of the cyclical sectors that are more sensitive to better economic growth. And when it rallies, if it rallies over the next several months, maybe take advantage of the strength to sell off the bond-like stocks that are real sensitive to interest rates or defensive stocks, and to plow that money back into more economically sensitivity. I still think the bull market's intact and is going to go higher again next year.
So you believe, as Mark did, that a positive economy is going to trump, from the market's standpoint, is going to trump the effects of rising interest rates. That's basically your view here.
I think so, Tyler. I really do. I really think if you go back a couple of years when we were worried that the Armageddon was coming and where the world was going to end, we would have loved to have today. In some way, today, to me, should be a celebrated milestone rather than some scary event. Because really what happened today was that even the Fed now, which has been very worried about the economy, is admitting that it is indeed getting strong enough that it can start to back off from stimulating so hard. That's a great thing. That means it can stand on its own 2 feet, and that's great longer term for equities.
But as much as you're saying all of this, investors are still scared by seeing these triple-digit gains and triple-digit losses, like today, markets selling off on what presumably is a good news day. So is there a way that individual investors can benefit from this volatility, play with it?
I think so, and I think that's what I'd look. I'd keep your eyes on not necessarily day in and day out or month in and month out. Look where you are from a year ago, and you're still making good progress. And on days like this, rather than fear, I'd go hunting for bargains today. I'd look at maybe like the technology stocks you've been wanting to get into, or maybe some of the beat-up industrials. And to take advantage of people wholesale dumping those today and buying on that weakness in anticipation that maybe it'll oscillate over the next several months, but a year from now I'll be happy I bought those.
So you've mentioned a couple of categories of stocks where you might be doing some cautious or maybe even a little incautious buying. Technology, cyclicals, industrials. I assume you mean the big equipment makers, the CATs and so on and so forth, and other industrials. You mentioned a moment ago, though, that you would lighten up on stocks that perform like bonds. What comes to mind there would be utilities and telecoms. Am I right?
Yeah, that's right, Tyler. I think both of those pay a high proportion of their earnings out in dividends every year, and they're a lot like a bond, which just pays a constant coupon payment every year. So when interest rates move, they really affect the performance of those stocks. And utilities and telecoms are getting hit in the last month or so as bond yields have moved up. If bond yields continue to move higher, those stocks are going to underperform other equities. So I would take advantage of days when they rally to maybe lighten up your exposure there and to move away from there, because I think over the next year or so, those are not good areas. I think another popular index that people plowed into is the dividend aristocrats, the highest paying dividend stocks, and I would move away from that and move to more economic sensitivity.
All right, lots of good information. Thank you so much, Jim, as always. Jim Paulsen, Chief Investment Strategist at Wells Capital Management.
Well, Susie, FedEx might quibble just a bit with the Fed's view that the economy is improving. CEO Fred Smith called economic growth sluggish and said customers are choosing lower price shipping options instead of priority services. Profits at the big package delivery company fell 45% in the last quarter, and FedEx lowered its growth forecast for the year. Nevertheless, shares of FedEx rose 1% today, in part because per-share profits, though down, were better than Wall Street forecasts.
As we said earlier, one of the key areas the Fed focuses on is housing, and it might start taking notice. The Mortgage Bankers Association says mortgage applications fell more than 3%. The culprit here? Mortgage rates hitting their highest levels since March of last year.
Meantime, four of the country's biggest mortgage servicers have been accused of failing to live up to their end of a $25 billion national mortgage settlement to help struggling homeowners stay in their houses. After 59,000 complaints, the federal watchdog overseeing that settlement with banks and other lenders says that Bank of America, JP Morgan Chase, Citigroup, and Wells Fargo each failed to pay fines levied against them or correct problems they were ordered to fix. For more on this story, log on to our website, nbr.com.
You hear this all the time. When banks, other companies, or individuals settle charges of wrongdoing with Wall Street's federal regulator, they're often allowed to pay fines without admitting any guilt. But not anymore. Mary Jo White, the new head of the Securities and Exchange Commission, will now require admissions of wrongdoing in cases involving serious fraud or harm to investors. Here's what White said about the new directive earlier today.
It will be, to some degree, case by case, but obviously with some, guidance for the staff as to what kinds of cases. And I think among the, kinds of cases that you'll look for are, you've got to balance everything, really. Strength of case, harm done, how egregious the conduct was, how important it is perhaps to get a quick resolution.
The new policy came out of a review that White began when she joined the SEC in the spring. And still ahead on the program, obesity is declared a disease, and it could have widespread implications. Doctors, insurers, and people who struggle with their weight. But first, here's a look at how the international markets closed today.
Microsoft says it has taken down a global cyber crime ring, freeing up millions of computers from an insidious virus believed to have ripped off $500 million from infected PCs before it was discovered. Now, the company's digital crimes unit worked with authorities in more than 80 countries to track down the so-called Citadel botnets that infected at least 2 million units, most of them in the U.S., Europe, and Hong Kong. And just today, Microsoft announced plans to recruit computer experts to help identify and fix major security flaws in its latest Windows operating software. It's offering rewards of up to $150,000 for these hacker whackers. To qualify, though, you got to be age 14 or older.
There's apparently no bonus for George Zimmer. He's the founder, executive chairman, and chief pitchman of Men's Warehouse. You know him from his commercials where he says, "You're going to like the way you look, I guarantee it." Well, after 40 years at the retailer, Zimmer was fired today by the board of directors. In a statement, Zimmer said that he and the board have been at odds for months about the direction of the company, and that, quote, "instead of fostering the kind of dialogue in the boardroom that has in part contributed to our success, the board has inappropriately chosen to silence my concerns through termination."
Turning now to market focus. On a day when the Fed was the driver, some stocks had stories quite their own, like BlackBerry, downgraded by Bernstein Research to underperform. Bernstein says fewer than expected companies and individuals have stepped up to the BlackBerry 10 smartphone. Shares of BlackBerry up more than 30% in a year, dropped nearly 4.5% today to close at $14.18. And Sprint lost ground as Dish Network walked away from making a new takeover bid, and Macquarie downgraded Sprint to neutral, recommending that investors take some profits there. The shares of the company dropped more than 4% on almost 3 times the normal volume, closing at $7 right on the nose. Sprint still up more than 120% over the past year.
NVIDIA says it'll begin to license its chip technology to third parties. It's responding to increasing demand for high-quality graphics on mobile devices. Shares of NVIDIA gained more than 3% today to close at $14.84, and it's up more than 21% this year. And Micron Technology reported quarterly profits above expectations on sales of $2.3 billion. Shares set a new 5-year plus high before the report was released right after the market close. On the day, Micron gained 1.5%, closing at $13.97. The stock has more than doubled in a year.
Some trouble ahead for one of the signature features of healthcare reform. A report from the nonpartisan Government Accountability Office says that the new health care exchanges being set up by the federal government in more than 30 states may not be ready for open enrollment by the October 1st deadline. The problem? Key frameworks of the exchanges, like eligibility for federal subsidies and monitoring of insurance plans and what consumers pay, have not been worked out just yet.
Sugary drinks should not be purchased with food stamps. So say the mayors of 18 cities, including New York, Los Angeles, and Chicago. In a letter to congressional leaders, the mayors say it's time to test and evaluate limits to the use of federal subsidies to purchase sweetened drinks that often lead to obesity and costly weight-related illnesses.
And speaking of obesity, as municipalities fight that obesity epidemic, the American Medical Association now says obesity should be classified as a disease. Bertha Coombs has more on what that could mean for businesses, insurers, and who pays for health care, and more.
Obesity's long been called an epidemic, contributing to a host of chronic diseases, with more than 35% of Americans very or extremely overweight. Now the American Medical Association has decided it's time obesity itself is classified as a disease.
We want to reduce and prevent type 2 diabetes. We want to reduce the impact of cardiovascular disease. Obesity so interrelated to both of those.
The Obesity Society, among those who've been calling for a disease designation, hailed the move.
Obesity, which affects 1/3 of the population, is something that people don't routinely discuss with their doctors until it starts resulting in things like diabetes and heart disease and joint disease.
It's because of those costly, serious chronic conditions most large employers have been on the forefront of fighting obesity in the workplace. More than 1/3 offer on-site Weight Watchers programs. About 1 in 10 offer incentive payments for reaching wellness goals. More than half also cover lap band and bariatric obesity reduction surgery under insurance benefits.
They're going to continue doing that because They're looking at different ways in which to manage and control healthcare costs, and this is just one of many ways that I see them continuing to try and control their costs.
Yes, they cover the lap band, and most insurance companies cover bariatric surgery, but that's after the patient has already gained at least 100 pounds over the course of their lives.
Boston University's Carolina Povian says calling obesity a disease will now allow doctors to take medical steps before a patient becomes drastically obese.
I think this is a necessary step to prompt insurance companies to treat this disease earlier.
The AMA's Council on Science and Public Health had actually recommended against designating obesity as a disease, saying it was too problematic to define, especially when you have people who are overweight but otherwise healthy. Still, 60% of delegates decided to approve the measure. For Nightly Business Report, I'm Bertha Coombs.
And coming up, how to prevent the next railroad disaster and what it could cost. Congress is taking a look. But first, a look at how commodities, treasuries, and currencies fared today. J.D. Power & Associates out with its latest survey on initial quality for new cars. Topping the list again is Porsche, which averaged only 80 problems per 100 vehicles. GMC ranks second, rising from number 12 last year. Lexus, Infiniti, and Chevrolet round out the top 5. At the bottom of the list, Toyota's Scion unit, dead last. Fiat not far behind for the second year in a row. Mitsubishi, Nissan, and Mini finish out the lowest rated nameplates.
Electric car maker Tesla is recalling 1,200 of its 2013 Model S cars due to a defect in the back seat. No injuries or incidents have been reported over the faulty seat latch. It's the first recall ever for the car maker, which recently received a near-perfect rating from Consumer Reports magazine.
At a Senate hearing today on consolidation in the airline industry, lawmakers urged the Obama administration to take a careful look at the proposed merger of American Airlines and rival U.S. Airways, which would create the nation's biggest carrier. The concern is that with so many carriers combining and fewer choices, consumers may pay too much for airline tickets. And now to concerns about the safety of the nation's aging railroads and the rail beds. After a series of high-profile derailments of passenger and freight trains, another group of senators held a hearing today on how to upgrade the country's railroad infrastructure, how much it will cost, and who will pay for it. Hampton Pearson has more.
Just days before two trains collided and derailed last month near Bridgeport, Connecticut, injuring at least 70 people, weakness in rail joints on the track were detected, but no action was taken. The NTSB investigation is not complete, but on Capitol Hill today, Chairman Deborah Hersman told lawmakers how the condition of that track might have set the stage for the accident.
It is the joint bars that join those two sections of track. The hanging ties indicates that the rail and the ties were unsupported.
Rail safety is getting lawmakers' attention after 3 accidents last month, including a fiery crash involving a freight train carrying chemicals colliding with a garbage truck outside Baltimore, and another Connecticut train wreck where a veteran railroad worker was killed while working on the tracks. A railroad worker spokesman talked about fatalities and their impact on the surrounding communities.
It's not just for the employees. Every time we have one of these major collisions that kills an employee, the surrounding community is also involved.
Meanwhile, the railroad industry and the federal government are on a collision course for meeting a 2015 mandate to install updated anti-crash signaling technology called positive train control. Lawmakers getting mixed signals from the industry. Some want a 3-year delay. Others say it should be done on a case-by-case basis.
I'm not sure that a case-by-case basis is music to the ears of anybody who's regulated by the federal government.
It strikes me, at least, that it would make a lot more sense if we're talking about doing some sort of an extension for compliance with this, to do it in a way that recognizes that all the railroads are going to have to comply with that and do some sort of a blanket extension.
Lawmakers and the railroad industry are also at odds over the billions needed to pay for track improvements nationwide and railroad bridge repairs. For Nightly Business Report, I'm Hampton Pearson in Washington.
And finally tonight, we've all heard the joke about someone trying to buy the Brooklyn Bridge, but how about buying the Empire State Building? That's almost what happened when a top New York City real estate company offered to buy the iconic skyscraper for $2 billion in cash from the family that now controls the building. The offer is lower than the tower's recently appraised value, and it comes just weeks after investors approved a plan to take the Empire State Building public, selling stock in what's called a real estate investment trust. So far, no comment from the building's owner on the offer. Ty, I'd say it's priceless, huh?
Well, I think it is. I think King Kong is going to get into the bidding here pretty soon. We'll scratch together some money. Maybe we can buy it. Be nice to us.
That's Nightly Business Report for us. I'm Susie Garrow. Thanks for watching. Have a nice night.
And I'm Tyler Matheson. Thanks from me as well. Read more about today's business news on our website, nbr.com. And meanwhile, we'll see you back here tomorrow.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Garrow with a Nightly Business Report news brief. Fed Chairman Ben Bernanke said the U.S. economy is getting better, and if forecasts hold up, the bank could begin cutting back on its monetary easing plans as early as this year. Policymakers also left the Fed's key interest rate unchanged. The Dow tumbled on that news, falling 206 points. The Nasdaq lost almost 40, and the S&P was down about 23 points. Yields on the 10-year Treasury note shot up to 2.35%, a level we haven't seen since March of last year. Applications for new mortgages fell more than 3% last week as mortgage rates hit a 15-month high. The Dish Network dropped its $25 billion offer to buy Sprint, and Men's Warehouse fired its founder and chief spokesman after 40 years at the retailer. Be sure to tune into Nightly Business Report right here on your public television station.